And then my final task is to introduce our chair for today, and it's Hema Moodley. Hema, what's your exact job title these days?
Head of Tax.
Head of Tax at SAB, or South African Breweries, I should say. And she was educated at the University of Durban-Westville, as well as the University of the Northwest. She completed her MCom taxation in South African and International Tax, and is registered as a Master Tax Practitioner with Sait. She completed her MDP through SAB in conjunction with UCT, and she's now pursuing her doctorate in taxation. So it's soon going to be Dr. Moodley. Hema has been in the field of tax for more than 18 years, and she's experienced across a whole range of areas in taxation, including corporate tax, transfer pricing, VAT, excise, customs, withholding taxes, international tax, employee tax, etc., etc. Hema has worked for SARS, Arthur Andersen, PwC, Total, Vodacom, and for the past 7 years with the South African Breweries, where she manages the full tax function for the SAB group. So please join me in welcoming Hema.
Thank you, Michael. I think I've been given the opportunity this morning to introduce two very well-renowned speakers. Firstly, Jackie Arendse, Professor Jackie Arendse will be, I think she needs no formal introduction, has been with in the tax fraternity for a significant amount of time. And post the tea, we are having KPMG represented by Mohammed Soluji, as well as Leslie Isherwood. I think before we do the formal introductions, I think it's worthwhile just taking stock of what has transpired over the past 2 days. And it's quite apparent that the Tax Administration Act, and it's quite a welcome framework, I think, for everybody, I think taxpayers alike in South Africa, as it aims to regularize the powers and the conduct of SARS. It also ensures that the taxpayers' rights are protected, as well as ensuring that the taxpayers' obligations are met. I think there's some common themes that is quite evident in discussions that happened over the past 2 days, and arising from the audits as well as the information gathering powers of SARS. I think firstly, let's look at the frequency of audits. I think it appears that some taxpayers are constantly audited and have to manage at least 4 to 5 audits at any one particular time. While on the other hand, there were some complaints that there isn't sufficient SARS audits. So SARS, please take note. Some people want to be audited more frequently. And we understand that SARS needs to do their job, but business also needs to operate, and we have to function, and we have to be able to make profits in order to pay our fair share of taxes. So I think what's expected, or what we want, is basically some kind of coordinated approach in terms of when and how audits are conducted, so that, I mean, I experience firsthand, I'm currently managing 5 audits simultaneously, and there needs to be some kind of reasonable sort of mix in terms of how we manage this. The second issue that's come out was the fact that SARS appears to come across with some preconceived views when they approach a taxpayer, and to change those views becomes quite difficult, irrespective of the evidence that's provided to support the auditors. So you end up with an assessment anyway. And I think that talks to the fact that there's some kind of fundamental breakdown in the relationship between the SARS and the taxpayer, because there's a significant element of mistrust. I think we need to be able to manage that, otherwise the whole tax system in this country is going to be very much at a brink where everyone's perceived as a big bunch of crooks, and that's not the case. So I think we need to manage that perception quite well. And on the other hand, I think SARS needs to be complemented as well with the automation that's taken place. I think we all can attest to the fact that there's been a significant automation and modernization programs that makes electronic filing and our lives quite simple, despite the problems and hitches we have. But I suppose that's technology. But I mean, that's the positive that's come out of it. And I urge, I think, from my personal point of view as well, there seems to be quite a lack of commercial understanding of what actually happens in the business environment, and not every transaction that's done in business is done with the main or sole purpose to avoid tax. I mean, the tax tail doesn't wag the commercial dog. We actually have a business to do, and the fact that there are tax consequences, the tax avoidance is not the sole or main purpose thereof. And I think there also were discussions around procedural transgressions with little or no accountability on the part of SARS, the complexity of the tax legislation, and there's a call for simplicity, especially in the small to medium business environment. The cost of regulatory compliance far outweighs the prospects of making a profit, for example, let alone future growth and job creation for these small to medium enterprises. And I think that needs to be addressed. And there's been also a call for a list of what a senior SARS official is, and that needs to be made available. And what comes into question is the constitutionality of the power of such senior SARS official, and I think that will come, we're hoping for sooner rather than later. So it seems to be a mixed bag of issues that's come out, but I think it's quite apparent. In order for this framework to work, I urge all taxpayers to use the remedies that's available to them in the form of your SMOs, the ombudsman once it's appointed, the public protector, the courts, and potentially class action for that matter. So I think coming from the commercial environment, the biggest positive coming out of the TA for me is the fact that there's promises to be some certainty and closure on audits and queries, and provided that it works in the manner in which it's envisaged, and the fact that when we submit responses, it doesn't go into a big black hole and suddenly there's an awakening a month before prescription. So within the local governance framework within which businesses generally operate, I think that certainty and that closure is critical. So I think that is for us is the fundamental aspect of that, and I think that it just needs to work in the manner in which it's intended. Obviously, there's been a lot of discussion with regards to the attorney-client legal privilege and the confidentiality that it extends, and that's quite encouraging as well. And the alignment of the Constitution, PAJA, PAIA for that matter, Bank Act, I think that remains to be tested in the future. So I think from my side, that was just some of the key highlights or takeouts that's actually emanated from the discussions over the past 2 days. So I'd like to formally introduce this morning to our first speaker, Professor Jackie Arendse, and she's going to take us through the new penalty regime. Jackie's completed her training at Deloitte and qualified as a chartered accountant. Jackie worked for a top 100 listed company and then moved into academia at WITS, where she lectured, researched, and wrote many books and articles in all areas of tax for more than 16 years. In 2004, she was appointed project director for tax at SAICA, and where her main responsibilities included managing relationships with key stakeholders, especially SARS and National Treasury, enhancing SAICA members' tax competency, and representing SAICA in discussions with government and on tax legislation. Jackie was appointed as the head of the School of Accountancy at WITS in May 2009, where she served in that post until February 2013. She's authored numerous articles and publications in the field of taxation and served as an advisor for various professional bodies. She chaired the National Technical Committee of SAICA and was a member of SAICA's National Tax Committee and SAICA's Initial Professional Development Education Committee for several years. And she currently serves as SAICA's Academic Review Committee and chairs Sait's Educational Committee. She currently lectures postgraduate tax students at WITS, presents tax seminars around the country, and works in an advisory capacity on tax and education matters. Jackie is married to Mark, who's also a chartered accountant, and they have 2 adult sons. So over to Jackie.
Thank you very much.
Sure, thank you, and good morning to you all. I have to apologize to the people on this side of the room. I don't know if you realize you have a very bright light behind you, so if I don't look at you very much during the presentation, it's not that I'm trying to avoid you, it's just that it's blinding me when I look to that side. So please don't feel excluded. You're just coming from a very bright place. So I'm going to focus more on this side of the room. But it is indeed a pleasure to be presenting to you this morning. I must say, quite daunting, having followed a lot of the conversation over the last couple of days, and I think there have been some really interesting aspects that have come up. And to be in the presence of the people who kind of wrote the legislation and are in the process of changing the legislation. So bear with me. You probably know more about it than I do. I'm sure you do, since you wrote it. But I will put forward my perspective, and I hope that it will be useful for you. We did discuss taking questions, and obviously the questions have really added to the conversation over the last few days, but in some respects they've also detracted a little bit, because sometimes people have battled to get through what they wanted to cover. And so I think in terms of a balance, probably the best is to keep a question session for towards the end. So this session is quite a long session. It's running from now through until 10:30. And if we can perhaps keep the questions for the last half an hour or so, that will just enable me to cover everything that I need to cover. And you may well find that things that you want to ask about are things that I'm going to talk about anyway. So if you could just bear with me, and we'll see how we go. But if you have a really burning issue, then please raise your hand, and I'll try and see the hand, or our chairman here will see it and will alert me. Okay, so we're talking about the new penalty regime, and this is contained in Chapter 15, 16, 17 of the Tax Administration Act. And what we need to also bear in mind is that there are still some penalty provisions alive in the various taxing acts. So we still have some penalty provisions alive in the Income Tax Act, for example, VAT Act, and so on. So we can't disregard those other acts. We tend to think, well, all the admin provisions of the various acts have now been moved across to the Tax Administration Act, so that's where we'll find all the relevant provisions. But, for example, we still have the understatement regarding the provisional tax estimates, etc., and those penalties are still sitting in the fourth schedule to the Income Tax Act. So we need to still have reference to those various provisions. And then, of course, to add body to the Tax Administration Act, we also have to refer to the various public notices that have been issued, and in particular, I'll be talking about one that deals with incidences of non-compliance. So just to put this in perspective, when we talk about the new penalty regime, and I think it's actually set up quite nicely, it extends across these three chapters in the Tax Administration Act, chapters 15, 16, 17, dealing with specific types of penalties or sanctions in terms of criminal offences. Now, I think it's probably appropriate to say right at the outset that when we look at the changes in the penalty provisions, a large part of the motivation, I think, behind the legislation as we have it right now is to take away a lot of the subjectivity that may have existed under the old penalty provisions. So to a large extent, many of those final penalty applications really relied on the judgment of a particular SARS official or a committee, whereas now a lot of it is much more objective and it's driven by certain facts. So it's almost like, if this, then that. If this happens, that's a penalty. If these circumstances prevail, this will be the outcome. So it is much more objective, it's much more finite. I think it's much more possible to establish exactly what the penalty is going to be. Now, what we're going to do is, in terms of this presentation today, we'll follow the three different areas. I'm not going to say much about the criminal offences. Hopefully none of you get to that point. But we're really going to talk, starting from the administrative non-compliance penalty. We'll be drilling into that in quite a lot of detail, and of course the understatement penalty. And we've already heard over the last couple of days quite a lot said about these various penalty provisions, and some very interesting discussion yesterday around the transitional arrangements. Can these understatement penalty, for example, be levied on an understatement that happened prior to the implementation date of the Tax Administration Act. So we've already heard quite a lot about this, but let's go in and see exactly what these provisions actually tell us, starting with Chapter 15. Just in terms of the overview, perhaps let me not jump in there too quickly. If we look at the structure of the three different chapters, Chapter 15 is looking at administrative non-compliance, and it talks to fixed and percentage-based penalties. Chapter 16 talks about your understatement, as the name suggests, more serious non-compliance, cutting into tax evasion, where there's been an understatement of some form of tax liability, ranging from unintentional right through to tax evasion, and then of course the criminal offences over on the far end. Now, in terms of the administrative non-compliance penalties, we talk about general non-compliance, the fixed amount penalties, things like failure to submit the tax return, and then we also have various percentage-based penalties, which could link to late submission of certain returns or late payment of taxes. And in some situations, you'll see that penalties levied under specific tax acts, for example, I mentioned the underestimate of provisional tax in terms of paragraph 20 of the 4th schedule. That particular paragraph will say the 20% penalty will be levied, and it will be levied and linked into Chapter 15 of the Tax Administration Act. All right, so those specific tax acts still have relevance, but the procedure for imposing the penalty and the recovery of that penalty, that's really covered in terms of the Tax Administration Act. All right, so let's have a look at Chapter 15. Chapter 15 talks about your administrative penalties, as I mentioned, fixed amount penalties and your percentage-based penalties, and it also includes a provision dealing with the reportable arrangement penalty. The fixed amount penalties levied in terms of Section 210 and 211. 210 starts off by saying, and if I just pull out the wording of the legislation here, it says here that if SARS is satisfied that non-compliance by a person referred to in subsection 2 exists, SARS must impose the appropriate penalty in accordance with the table in Section 211. So, it's a case of, as I said earlier, if this, then that. If SARS is satisfied that there's an incident of non-compliance, SARS must impose the penalty in terms of the table. Now, what are the incidences of non-compliance? If we look at the previous legislation, there was a whole list of different types of non-compliance that could be capable of triggering a penalty. Here we are told that the incidence of non-compliance will be as notified through a public notice. And to date, we've had just the one public notice, number 790, which came out on the date of implementation of the Tax Administration Act. And that tells us that it's overdue personal income tax returns. So 2 or more income tax returns outstanding since 2006, and the fixed amount penalty will be levied. So at this stage, it's a very specific type of non-compliance that is targeted by this provision, but no doubt in due course that range will extend, and there'll be other things that are notified to us through the public notice. Notice also that late submission of PAYE reconciliations and various other types of late submissions, late payment, etc., could give rise to percentage-based penalties. In Section 212, we talk about the reportable arrangement penalty, and that again is a fixed amount penalty and applies to a participant who fails to disclose the information in respect of a reportable arrangement as required under Section 37. And it gives a specific amount of a penalty, initially 50,000 Rand in the case of a participant other than the promoter, or 100,000 Rand in the case of the promoter. But depending on the size of the tax benefit under the reportable arrangement, those amounts could either double or treble. And then you've got your percentage-based penalties under Section 213. For example, late payment of VAT has a 10% penalty levied under the VAT Act, but linked to this provision in Chapter 15. Okay, I can go past this one because you spoke about the report of arrangement. Let's just go back to the fixed amount penalty section 210. So the acts of non-compliance, as I mentioned, have been notified under the public notice, being specifically late submission of your personal income tax returns, and then you have your fixed amount penalties and your percentage-based penalties. Now, if there's an incident of non-compliance, as identified, we said late submission of tax returns. Once you have that non-compliance that has been identified, notice here that in section 210 it said, once there's an incident of non-compliance, SARS must levy the penalty in accordance with the table in section 211. And the table in section 211 you have before you on the screen there. So this table basically establishes, first of all, there's been an incident of non-compliance. Then we look at what is the amount of the taxpayer's assessed loss or taxable income in the preceding year. So that's the previous year of assessment prior to the point at which this penalty is being raised. And there, depending on the amount of that person's taxable income or if they have an assessed loss, that will determine the amount of the penalty that is going to be imposed. So if, for example, we had an individual with previous taxable income, 400,000 Rand, and they failed to submit a tax return, then essentially your penalty is going to be determined at 500 Rand. So that's the first off penalty, the fixed amount penalty, failure to submit the tax return if there's 2 or more tax returns outstanding since the date specified in the public notice. And then we'll go through the process, and I'll explain the detailed process in a moment. But just to sort of highlight at this stage that fixed amount penalty would be levied under a penalty assessment, but that's not necessarily the end of the story. And this is where things start getting rather expensive, is that if the non-compliance is not rectified by the date specified, then this amount becomes a monthly penalty that is charged. So it's all very well to say, well, 500 Rand penalty for late submission of a tax return, not too bad. But once that 500 Rand starts kicking in on a month-by-month basis over up to 36 or 48 months, that could become quite a substantial amount of money. So it's not just that it's a once-off penalty, it's a once-off penalty with this monthly imposition if the non-compliance is not fixed. Now, just while we are looking at this table, you'll see here that I've added in a couple of things, because as always happens in tax, things are never as simple as they seem at first glance, that you can't just simply say, what is your taxable income? There are some terms and conditions attached. All right, so if we look at the sort of section 211 and the text that comes underneath the table, you'll see there under line 2, it says if your taxable income is 0 to 250 plus 211 subsection 4. And that particular provision says to us that apart from some of the other entities I'm going to mention, if the taxable income for the previous year was unknown, or that taxpayer was not a taxpayer in that year, then SARS would impose a penalty under item 2. So if SARS can't establish your previous taxable income, or you weren't a taxpayer in that year, then you don't have a taxable income in the preceding year, then we revert to line 2 and we look at 250 Rand. Alternatively, if the person has been a taxpayer and SARS was unable to determine the taxable income for the previous year, there is recourse to SARS to say that SARS can estimate the amount of taxable income for that previous year based on available relevant material and then impose a penalty according to the appropriate column. All right, so there, as is indicated, SARS could raise an estimated assessment, estimate what that taxable income is, and perhaps they would estimate the taxable income comes in at 1.5 million Rand, then you're down to line number 5, and your penalty is 2,000 Rand. Okay, so that deals with the issue where you either can't estimate the taxable income for the previous year, or the person wasn't a taxpayer in the previous year. Then if we run down to line number 7, you'll see that I've said there plus entities mentioned in 211 subparagraph 3. And there, we're really looking at your listed companies and your very large unlisted companies, and to a certain extent some tax-exempt institutions. Because any company listed on a stock exchange, on the JSE, the recognised stock exchange as referred to in paragraph 1 of the 8th schedule. So any company listed on a recognised stock exchange, even if their taxable income is less than 10 million rand, they would still fall onto that line. So their penalty line would be 8,000 rand, unless their taxable income was more than 50 million, then they would go on to line number 8. So your listed and your very large unlisted companies are either going to fall under line 7 or line 8. When I talk about very large unlisted companies, we're talking about companies whose gross receipts or accruals for the previous year exceeded 500 million rand. All right, so we're talking seriously large companies here. And there's not many of them in South Africa, because we know most companies in South Africa are actually the smaller companies in terms of just sheer number of companies. Then the other company that could come onto that line number 7 in terms of that amount of penalty being levied is a personal entity exempt from income tax but liable to tax under another tax act if the gross receipts or accruals exceed 30 million rand. So your tax-exempt entity, a large tax-exempt entity, gross receipts or accruals exceed 30 million, but it's exempt from income tax. However, there are other taxes to which that entity is liable. Then, if they are subject to this penalty, the fixed amount penalty, they would also be looking at the 8,000 rand level. Okay, so it looks pretty simple at first glance, but it does have these various terms and conditions in terms of your large companies, listed companies, etc., and some of your large tax-exempt institutions. So having established where you fall, hopefully that's a fairly straightforward matter to establish which penalty is actually going to apply. Then we go into the penalty process. So SARS identifies there's been an incident of non-compliance. They identify which penalty, what amount of penalty is going to apply, and they would then raise a penalty assessment. And this is a penalty assessment, an assessment in the true sense of the word. And we're going to hear later this afternoon about the whole issue around assessments and what constitutes a valid assessment, etc. But SARS would have to raise an assessment on AP 34, which would identify to the taxpayer what is the incident of non-compliance, what is the amount of penalty that is being charged, and the date by which that penalty must be paid. Okay, so the AP 34 would show the due date by which the taxpayer must remedy the non-compliance and make the payment. Remember that if the taxpayer doesn't remedy the non-compliance by that due date, then that penalty that we've already identified is going to become a monthly penalty. And so it goes. And, you can literally hear the old cash register going ka-ching, ka-ching, and the penalty is getting higher and higher on a month-by-month basis for as long as that incident of non-compliance remains unresolved. Now, in terms of the SARS guide on penalties, they have indicated that debt equalization, this part comes straight from their guide, offsetting of credits on an assessed account against debits on the administrative penalty account is allowed, provided that the penalty transactions are not under dispute. So offset can be done. And notice that failure to remedy and or make payment by due date will result in the monthly penalties. All right. A question that often arises is, can interest be charged on the outstanding penalties? Well, remember that a penalty, once raised, is raised under a penalty assessment, the AP 34, and that's then regarded as a tax as defined in the Tax Administration Act. And so, yes, it is interest-bearing from the effective date, and that effective date, in relation to the original penalty amount, it's the date for payment specified in the penalty assessment, and for that monthly increment, it's the date of the increment. So the penalty, the increment does arise every month. It's an automatic increment thereafter. So you could end up with a rather large sum payable if you let this run for a few months or years, because this is accumulating. The penalty is accumulating. I mean, talking about compounding effect here. You've got the penalty accumulating and the interest that is being charged. So this is all going to add up to rather a large sum of money. Now, the personal income tax penalties, we spoke about the public notice, which indicated that the penalties for late submission of a tax return, that will apply for years of assessment commencing on or after 1 March 2006, where there are 2 or more outstanding tax returns. And we've seen these penalties being applied on quite a grand scale. Many individuals have been levied with these penalties, and in fact, I think a lot of the practical impact of this has been felt by the employers who've been, we heard about it yesterday around the process, but they've been appointed as a responsible third party, and they then have to basically apply a garnishee order to take the penalty off the individual's salary. What concerns me is that I think in many of those cases, not all of them, but in many of the cases it seems penalties have also been levied for individuals who failed to submit tax returns. However, the individual's taxable income was below the 120,000, and we know that in terms of the public notice relating to the submission of tax returns, those people didn't have to submit tax returns, yet they seem still to have been levied with penalties in some cases. Now, in terms of the monthly imposition of this fixed amount penalty, so we have the penalty levied at the outset for non-compliance, and then the monthly penalty that kicks in. This monthly penalty can keep going for up to 35 months after the initial penalty assessment. So you've got the initial penalty assessment, you've got a month basically to sort out that non-compliance and pay the penalty assessment, and then the penalty can keep running. If it's not sorted out, the penalty will keep running for 35 months. Now, just a point here, we talk about 35 months where SARS has the current address. That's 35 months from the due date of the penalty assessment. In the other instance, the 47 months where the taxpayer has failed to update their details. So SARS doesn't have a current address, is what the legislation says. But there, the 47 months is measured from the date of the initial non-compliance. All right, not from the penalty assessment. And it can go on, for 47 months, giving SARS the opportunity to chase up on the taxpayer and carry out their various recovery provisions, which you also heard about yesterday. Now, let's just have a look at some of the other penalty provisions that apply. So we spoke about the fixed amount penalties for late submission of tax returns. There's also the PAYE penalty. Apart from the late payment of PAYE, which attracts a 10% penalty under the fourth schedule provisions, there's also the penalty for the late submission of the EMP 501, the PAYE reconciliation. And there the PAYE penalty can run up to 10%. It's generally 1% per month for every month that EMP 501 is outstanding. And this is probably pretty relevant at the moment because this is something that's very much in people's minds. And up to a maximum of 10%. Subject to the circumstances of the case, the penalty could be proportionately remitted depending on the degree of compliance. That's from the SARS guide on penalties. In section 213, the Act talks about the imposition of percentage-based penalties, and it says here, if SARS is satisfied that an amount of tax was not paid as and when required under a tax act, SARS must, in addition to any other penalty or interest for which a person may be liable under this chapter, impose a penalty equal to the percentage of the amount of unpaid tax as prescribed in the Tax Act. So here we talk about, for example, your late payment of VAT, 10% late payment of PAYE, 10% penalty, and so on. So I've just listed a few examples of the different types of late payment. As I say, you would have to go to the specific Tax Act to find the actual penalty provision, but it then links into a penalty that falls under Chapter 15 of the Tax Administration Act. So employees tax, value-added tax, provisional tax, various penalties under provisional tax, your underestimation, failure to supply an estimate, late payment of provisional tax, those all link in. The withholding tax on the sale of immovable property under Section 35A. There would also be withholding taxes on dividends, withholding taxes on royalties, we could go on. There's other withholding taxes that will come in next year, withholding tax on interest, service fees, etc. are going to come in next year. So all of those various late payments still attract a penalty. You just won't find the specific penalty in the Tax Administration Act because those provisions are sitting within the specific taxing acts. So if you've been levied with a penalty, one of these penalties by SARS, and remember we're just talking about the Chapter 15 penalties at this stage. So that'll be your fixed amount penalty, your percentage-based penalty, and your reportable arrangements penalty. The recourse available to the taxpayer, of course, depends on two circumstances. Was the penalty correctly imposed or not? If the penalty was incorrectly imposed, we can just go down to the bottom of the slide there and deal with it fairly quickly, because you could, for example, SARS says you haven't submitted a tax return, you would provide evidence that you have submitted the tax return and complete a request for remission showing the reason not liable. Or perhaps you would say, I wasn't required to submit a tax return because I fell under the threshold mentioned in the public notice. Provide that information to SARS, indicate on the RFR that you're not liable for the penalty, and if everything happens the way it should, then the penalty should be reversed. All right, but what happens if, yes, in fact, the person has failed to submit a tax return, or they've paid tax late, etc., and the penalty has been correctly imposed? Again, if you're wanting to request a remission, you submit the RFR1 form. SARS does make the point that they will only consider that application if the non-compliance has been remedied. So it's no good saying, well, I had a power failure, so I couldn't submit my form on time, but we're now 3 months down the line and you still haven't submitted the form, but you want the penalty remitted. It's not going to happen. So you need to make sure that the non-compliance is fixed, then apply for SARS to reverse the penalty. Notice here that the request for remission will only be allowed where the circumstances beyond the taxpayer's control resulted in the non-compliance. If we look at the various penalty provisions, in Part E it talks about the remedies, and it gives various avenues to request a remittance for the penalty. And it talks in the first instance if the person's failed to register. Then it talks about the penalty for nominal or first incidence of non-compliance. So the issue is that if a person is applying for remittance under one of those provisions, then you would have to make sure that you fall within the ambit of the provision. I just wanted to see, I can't remember if I actually put that in there. Yeah, we'll come to that in a moment. All right, so let me not get too carried away at the moment. We're just going to do the overview for now. The request for remission must include an explanation of any exceptional circumstances which led to the non-compliance. So this again links in to the grounds for remittance. So if we look at the fixed amount penalties, the grounds to apply for a remission of a fixed amount penalty, in terms of the legislation, if a penalty has been imposed, the legislation says SARS may notice, remit the penalty up to 2,000 Rand, or up to 100,000 Rand if it's a reportable arrangement penalty, if SARS is satisfied that the penalty has been imposed in respect of a first incidence or an incidence of non-compliance as per 210, which is your fixed amount penalty non-compliance, if the duration of the non-compliance is less than 5 business days. Now, when we talk about the first incidence of non-compliance, we do have a definition. You'll see it's in inverted commas there. What do we mean by a first incidence of non-compliance? Well, that definition tells us that first incidence means an incidence of non-compliance by a person if no penalty assessment under this chapter has been issued during the preceding 36 months, whether involving an incidence of non-compliance of the same or a different kind, and for purposes of this definition, a penalty assessment that was fully remitted under Section 218 must be disregarded. 218, we're still coming to that. So the issue is that a non-compliance means that you haven't been levied with a penalty in the last 36 months. That's essentially what we're talking about here. So you might have once upon a time in your deep and distant past have had a penalty. Fortunately, that's not held against you forevermore. We regard you as starting on a clean slate if you've had nothing in the last 36 months. All right, so that's your first incidence. Then if we go on to the second aspect here, it talks about the incidence of non-compliance as per Section 10 if the duration of that non-compliance is less than 5 business days. All right, so notice there it talks about business days. So if you have a weekend in between, it could extend that period a little bit. So 5 business days, basically your Monday to Friday. And your incidence of non-compliance, we're talking about effectively your late submission of the tax return. So if it ended up going in less than 5 business days late, that is a ground for applying for a remission. But notice here, it talks about 2 circumstances. It says the penalty is either a first incidence or you rectify it within 5 business days. And, so it's either of those, and in addition to that, there must be reasonable grounds for the non-compliance, and the non-compliance must be remedied. All right, so those reasonable grounds is basically what you would have to motivate on your request for remission. What are the grounds? Why is it that you missed the submission deadline? And if there's reasonable grounds for non-compliance, then SARS could consider that. In terms of the percentage-based penalties, we have the provisions that say that the penalties levied under Section 212, your percentage-based, your late payment penalties, 20%, etc., SARS may remit the penalty or a portion thereof if satisfied that the penalty has been imposed in respect of a first incidence of non-compliance, we see there again, or involved an amount of less than 2,000 Rand. So we need to just be careful that we don't confuse this 2,000 Rand and the use of the 2,000 Rand here. In the previous slide, we said that SARS could remit a penalty up to 2,000 Rand if they're satisfied on the various aspects. Here we're saying that SARS could remit a penalty if the amount involved is less than 2,000 Rand, so small items, or if it's a first incidence, and we spoke about what first incidence means. So it's either of those eventualities, and in addition, again, reasonable grounds must exist for the non-compliance, and the non-compliance must be remedied. All right, so if you were filling out a request for remission, you would have to have regard to the appropriate provision. Is it a fixed-based penalty, or is it a percentage-based penalty, and then look at the grounds that SARS can look at for remitting the penalty and structure your request for remission around that. Now, in terms of Section 218, you'll notice that Section 218 also talks about grounds for remittance, but here it starts off by saying SARS must remit a penalty in certain circumstances. So this is different to the 217, which says SARS may remit, all right, fixed amount, and also under the percentage base, SARS may remit. So this issue around must, may, we've picked that up by now over the discussion of the last few days, very relevant as to whether the word says must or may. So in terms of Section 218, the provision states that SARS must, upon receipt of a remittance request, remit the penalty. All right, so this is not up to the discretion of the SARS official. If the circumstances in Section 218 apply and you submit your form, SARS must remit. So that sounds great, but the issue is obviously this is not going to happen very easily. So what are the circumstances in which this particular provision will apply? Well, it states here that SARS must be satisfied that one or more of the following circumstances rendered the person on whom the penalty was imposed incapable of complying with the relevant legislation. So if the person has paid an amount late, submitted a tax return late, etc., are one or more of these circumstances prevalent that would have rendered the person incapable of actually meeting his obligation? And you'll see these are quite extreme circumstances, as we would expect. So we talk about a natural or human-made disaster. A tsunami, an earthquake, somebody blowing up the building, that type of thing. And I think, I was sitting in the traffic this morning, which was just not moving at all, and I was thinking, I wonder if this would qualify as a disaster, if this caused me to miss this presentation, for example, or to miss a deadline. How extreme must it be to be a disaster? It's a disaster in my life. I don't know if it features on the front page of the newspaper, but what exactly is a disaster? I guess that's a little bit open to interpretation. Some of us are maybe a little bit more theatrical than others. What one person regards as a disaster, another one would say, well, that's just life, deal with it. So I think it is a little bit subjective, perhaps, but nonetheless, it is a grounds that you can use in Section 218. Civil disturbance or disruption in services, has there been a riot, a protest, has there been a disruption in postal services? I'm still getting things delivered, carried over from the disruption in the postal services. Serious illness or accident, serious emotional or mental distress. Okay, and I think a large part of Joburg is suffering from that right now. But anyway, and then it goes on to talk about errors by SARS. So it says any of the following acts by SARS capturing error, processing delay, provision of incorrect information in an official publication or media release issued by the Commissioner, delay in providing information to any person. And I think this is something we often overlook. We complain about the delays from SARS. Well, there is recourse here to a certain extent. That if SARS has unreasonably delayed something, then it is grounds to request an automatic remission. SARS must remit if this circumstance exists. Failure by SARS to provide sufficient time for an adequate response to a request for information by SARS. So when SARS asks for the last 10 years of information, they give you 5 days to respond. That could fall into this category, failure to provide sufficient time for an adequate response. So hidden within this, there are certain grounds, and I think this is where taxpayers could maybe have a look at this and say, well, there are grounds to request this remission based on this, under the banner of errors by SARS. And then the last serious ground is serious financial hardship, such as, so it's not limited to these items, but it could be in the case of an individual, lack of basic living requirements, or in the case of a business, an immediate danger that the continuity of business operations and the continued employment of its employees are jeopardized. We spoke yesterday about SARS accessing bank accounts, taking money out of bank accounts, etc. I mean, that could seriously jeopardize the ongoing, or the ability to operate as a business. And that would perhaps be something that would be considered. And then it goes on to say any other circumstance of analogous seriousness. So if you can think of anything else that is as serious as any of those things that are mentioned there, it could come in as well. So this is not limited specifically to the things that are listed here, but you can see that it is limited to things that are pretty serious and are not things that are happening really on a day-by-day basis. Hopefully it's a sort of an exceptional situation. So it's talking about, and the title of the paragraph in the Act talks about remittance in exceptional circumstances. All right. So it is possible to apply for a remission of a penalty. SARS has levied a penalty. It is correct, you were late, but there were exceptional circumstances which fall under one of these categories here. You could then outline those circumstances, explain those circumstances, and apply for that penalty to be remitted. The dispute procedure for penalties, SARS says in their guide, is tax-focused, tax-type focused. So, I mean, you might have different types of penalties for late payment of VAT, for example, but also different types of penalties for late payment of employees' tax. And they do make the point that penalties should be disputed per tax type. So don't dispute EMP 501s with late submission of tax returns, for example. But they do make the point that a single request for remission form can be completed for multiple transactions per tax type. And if the number of transactions exceeds the available containers on the form, then you can get an additional form. So depending on how many penalties it is that you are being faced with at any particular point in time. If a penalty was incorrectly assessed, SARS does have the right to issue a revised assessment, and that's in terms of Section 219, within 3 years of the original penalty assessment. Now that is interesting because at the time SARS raises a penalty assessment for, let's say, late submission of a tax return, etc., they would look at the prevailing circumstances, and they may regard that the taxable income was X, and going back to that table that I showed you, they would be levying a penalty according to that level of taxable income. But perhaps it changes. Perhaps they reassess the taxpayer and the taxable income changes. What this is saying is that SARS could levy an additional penalty, the higher penalty, according to the correct amount of penalty that should have been levied, and they could do that within a period of 3 years from the date of the penalty assessment. If a person appeals against a penalty or requests a remission of the penalty, obviously there's then a decision of SARS that has to be taken, and they would decide whether to allow that remission, partially allow it, or disallow. And that decision obviously is a decision that the taxpayer can dispute. So if the taxpayer doesn't agree with the outcome of the decision around the request for remission, they can object using the NOO, the Notice of Objection form. Typically, and we've seen this especially with individuals who are levied with late submission penalties, they cannot pay the amount of penalty that is owing, and so they would make arrangements. It is possible to make deferment arrangements for outstanding penalty amounts, as long as the taxpayer, as I mentioned earlier, has remedied the non-compliance. When a taxpayer requests the remittance, an automatic suspension of the duty to pay and SAR's right to collect, and this is important to bear this in mind, that when you submit a request for remission, SARS may not take further steps to collect the tax, and that sort of window runs from the day the application is submitted the day the decision is taken around the request for remission until 21 business days after that decision is taken. So for that period of time, SARS may not take steps to recover the tax unless there is risk that the assets are going to be dissipated, that SARS would not be able to recover the assets, or if there's fraud. Okay, so that's essentially the Chapter 15, the fixed amount penalties. So as you can see, it's in some respects it's fairly straightforward, that it's relatively easy to identify how much penalty is going to be levied. But on the other hand, there are a number of quite intriguing and complex provisions that have to be taken into account as well. But just to recap before we get on to Chapter 16, that Chapter 15 effectively covers three broad categories of penalties: fixed amount penalties for non-compliance, which at this stage we talk about late submission of the tax return. It talks about reportable arrangement penalties, and it talks about percentage-based penalties, which could link to late submission of a particular return, and it could link to late payment of taxes. All right. Let's get on to Chapter 16, which deals with the understatement penalty. So here, as if we could think about that framework that I showed you at the beginning with the three different areas, the Chapter 15 non-compliance administrative penalty, that was a sort of the lesser degree of seriousness. Chapter 16 is getting into more serious territory where there has been some form of understatement of a tax liability. Now, it could be that that understatement arose because of a completely honest mistake, or going right across to the far end of the spectrum, it could have arisen because of intentional tax evasion. Now, under the old penalty provisions, SARS could have and often did apply a penalty of 200%, and then it would be up to the taxpayer to argue around getting that penalty reduced. That doesn't happen under this new provision. Under the new provision, depending on certain circumstances, again, it's fixed and, well, it's a percentage base, but the amount of the percentage is fixed in the legislation, that this particular percentage will apply. What is interesting, though, is that in terms of the onus of proof, Section 102 of the Tax Administration Act tells us that the burden of proving the facts on which SARS bases an understatement penalty under the section is on SARS. So SARS has the burden of proof to show the existence of the facts that they use to determine the amount of the penalty. All right, and that's a fundamentally important point to bear in mind, because if the taxpayer manages their risk appropriately and has the necessary documents, processes, etc. in place, they should perhaps be able to argue against a particular accusation that SARS has levied. And then the onus is on SARS to prove that the facts actually existed. All right. Now, under this particular understatement penalty, if we start off by saying, well, what is an understatement? What are we talking about? An understatement means any prejudice to SARS or the fiscus in respect of a tax period as a result of various things. So notice here, first of all, there must be prejudice to SARS or the fiscus. They must have lost out on something. So the most obvious one is, well, if your taxable income should have been 10 million, but you only declared 1 million, obviously SARS has lost out on the tax on the balance of the 9 million. So the prejudice to SARS is the tax on that 9 million. It's the difference between what should have been the liability and what the liability was based on the information that you provided. All right, but it does go on to say that this prejudice has arisen as a result of 4 different circumstances. And we'll get onto that in a moment. But I think that the main thing is to just understand, when we talk about understatement, there has to be this prejudice to SARS or the fiscus. And then we enter the territory of the understatement penalty, which we'll talk about running through section 221 through to 223. And then we'll talk again about objection appeal and the voluntary disclosure program, but we had a wonderful presentation on that. So I'm not going to say too much about that, but just to show and demonstrate the linkage and how that ties into this understatement penalty. Okay, so getting into the detail of this definition of understatement, we've mentioned about prejudice to SARS or the fiscus, and the 4 different circumstances: default in rendering a return, an omission from a return, an incorrect statement in a return, or, if no return was required, the failure to pay the correct amount of tax. Okay, so the default in rendering the return, obviously you've simply failed to render a return, but had you rendered a return, a tax liability would have been established. We can identify what the prejudice is there. Omission from a return, that's pretty obvious, that you failed to declare certain income. An incorrect statement in a return. For example, let's get into the whole small business category. If you say, are you a small business corporation? Yes, but actually you're not. I think that could fit into this, that you've made an incorrect statement. Perhaps somebody does that because they think because they're a small business, they must be a small business corporation. They don't know that there's a specific definition in the Income Tax Act. So you're saying, oh, but I didn't mean to be dishonest. We'll get onto that just now as to perhaps what the consequent penalties would be. All right, but it is an incorrect statement. And then if no return is required, failure to pay the correct amount of tax, because there you're paying the amount of tax depending on the particular transaction. So whatever you should have paid versus what you did pay, the difference is the prejudice to SARS. Okay. So having established that there's an understatement and the prejudice to SARS, etc., what is the amount of the penalty? Well, the penalty, and let me just jump forward and then I'll come back to that slide in a moment, because it's a good idea to just have this picture of the table in our minds when we talk about the detail. The understatement penalty table set out in section 223 tells us, as you can see on the slide there, it gives certain types of behavior and then certain percentages that will apply. So if, for example, you fall into the definition of substantial understatement on the particular case that is before SARS, then they would apply the percentage. If it's a standard case, 25%, obstructive case, 50%, and we look there at the VDP, which could bring that penalty down to either 5 or 0%, depending on whether you make your VDP application before or after notification of an audit. So if we just think about that penalty table, and the percentage penalty is going to be determined according to that table, and I'll come back to more detail on that table in a moment. But let's just go back to this section 222 then. So the amount of the penalty. We are told in section 222 that where there's been an understatement, the taxpayer is going to pay the penalty levied, and it's going to be the highest penalty according to that table. So if there's more than one sort of circumstance, maybe you've got a substantial understatement, but there's also been gross negligence, you would take the higher of the appropriate penalties. Okay, so that is point number one. Secondly, we're going to apply that penalty to the prejudice, basically. We said there must be a prejudice to SARS or the fiscus. So we're going to say the amount of the shortfall multiplied by the percentage, that's going to be your penalty. And then we've got specific rules around how to measure the shortfall, but it is fairly logical, as you would expect, that it's the difference between the amount of tax properly chargeable and the amount of tax that would have been chargeable if the understatement was accepted. So if you declared taxable income of 1 million rand, what would your tax have been? Versus the correct amount that should have been 10 million rand, what would the tax have been? The difference is the tax on that 9 million rand, and that is effectively your shortfall. So it's the difference in the tax, right, that would have been chargeable on the correct amount versus the incorrect amount. So the tax on the 9 million, is it just noise in my head? All right. The tax on the 9 million rand, I'm hearing voices. I hope it's not just internally here. But take the 9 million rand, whatever the tax would be, say 28%, and that is your shortfall. Then you apply the appropriate penalty. And then, of course, if there was an amount refundable, perhaps you've received an incorrect refund, the difference between the amount properly refundable and the amount that would have been refundable had the understatement been accepted. And C, the difference between the amount of an assessed loss or any other benefit to the taxpayer properly carried forward from the tax period to a succeeding tax period, and the amount that would have been carried forward if the understatement were accepted. So there are a number of circumstances where we have carry forward amounts. I think, for example, with STC credits being carried forward, there could be various other things where you have carry forward amounts that have been determined based on certain information. And again, if that has been incorrectly determined and you've carried forward too great an amount, what would be the difference? And there you'd say the difference is effectively your shortfall. Okay. Then, as I say, multiplied by the appropriate tax rate, ignoring any assessed loss or any other benefit brought forward from a preceding tax period. So just look at, in isolation, that particular year, as it were, ignore any carry forward of assessed losses, and the amount of tax shortfall is the shortfall we're looking at. So once we've established what that shortfall is, then of course we have to calculate the penalty by taking the shortfall multiplied by the appropriate percentage. And this is where things get really interesting, because it's not that much of an easy matter to determine necessarily exactly on which line this particular penalty is going to fall. In the first instance, substantial understatement, there you will see it's in inverted commas, it's a defined term. So that one we can determine with a high degree of accuracy, because substantial understatement, we are told, is a case where the prejudice to SARS or the fiscus exceeds the greater of either 5% of the amount of tax properly chargeable or refundable, or R1 million. So if you have understated your taxable income, in the example I used, should have been 10 million rand, was 1 million rand, take the amount of tax on that 9 million rand, it's going to come to an amount greater than R1 million, then you would use that greater amount, okay? And if the, I'm jumping the gun here. The 5% of the amount of tax properly chargeable, I knew I'd got that wrong. 5% on the amount of tax chargeable on the 10 million rand. So you'd say the amount of tax on 10 million rand would be 2.8 million rand, or R1 million rand. The higher amount is 2.8 million rand. And is the prejudice to SARS more than the 2.8 million rand? If it is, then that's the substantial understatement. Sorry for getting that calculation a bit mixed up there. So the 5% is based on the tax properly chargeable versus R1 million rand. Take the higher of those two numbers, compare your prejudice to SARS. If the prejudice to SARS is more than the greater of those two amounts, then you're into the area of substantial understatement. So that's a very factual amount, and it really is dealing with pretty large sums of money. Apart from that, you're into the more subjective areas, which are the areas, and you'll see none of those are defined terms. They are simply areas of reasonable care not taken, no reasonable grounds taken for a tax position. Tax position is defined, but the no reasonable grounds isn't a defined term. What is gross negligence? Intentional evasion. So here, it would be up to SARS to prove that that particular situation exists. Now, we don't have, and nor are we going to have specifically defined terms around reasonable care not taken, etc. So how do we decide what this actually means? Well, we do have the SARS Short Guide to the Tax Admin Act, which gives us a little bit of explanation on these areas. Otherwise, we need to look at the ordinary meaning of the word, and fortunately, we do have a little bit of illumination from across the sea, because the Australian Tax Office has put out some guidance to their taxpayers around very similar concepts, and so that does give us a little bit of information. Sorry, let me just substantially understatement, I forgot it on the slide there. Tax position, just deal with this definition, then we'll go into some of the other terms there. Tax position, remember that we spoke about the one line here saying no reasonable grounds taken for a tax position on line number 3. So what we mean there by tax position, what we have got defined is tax position in section 221, and that talks to an assumption underlying one or more aspects of a tax return, including whether or not an amount, transaction event item is taxable, or an amount is deductible, or a lower rate should apply, or an amount qualifies as a reduction of tax payable. So that is the definition of tax position. But what exactly we mean by no reasonable grounds taken for a tax position, that is not specifically told to us. So when we look at the SARS guide, let me just give you some indication of what they have said about these various aspects. In terms of reasonable care not taken, the SARS guide says that, makes the point that reasonable care is not defined, so we need to look at the ordinary meaning of the word, and makes the point that taxpayers are legally responsible for their tax affairs. A taxpayer is expected to take reasonable care in keeping records and providing complete and accurate information to SARS. Then it goes on to explain that reasonable care means that a taxpayer is required to take the degree of care that a reasonable ordinary person in the circumstances of the taxpayer would take to fulfill his or her tax obligations. Well, what actions would a reasonable ordinary person take? Would a reasonable ordinary person read every document on the SARS website, read the legislation, study all the case law lying behind the tax legislation? I mean, it depends, doesn't it, on who's completing that tax return. I think if you're a tax specialist and you're completing that tax return, then there would be a certain expectation, whereas if you were a small businessman who doesn't have the money to pay a tax specialist and they're completing your own tax return, there's probably a different level of expectation. So it makes a point here that, for example, a taxpayer should try his or her best to lodge a correct tax return. So that, I think, is expected of all of us. At least try and get it right. Okay? Although a taxpayer is liable for the actions of their employees, the question of whether the taxpayer has taken reasonable care must still be considered. The reasonable care standard does not mean perfection, but refers to the effort required commensurate with the reasonable person in the taxpayer's circumstances. And remember that old saying, looking at the man on the Clapham bus, you know, what would you expect? So what's a reasonable man? But of course, I think it does depend on the level of education, and tax practitioners, registered tax practitioners, we're going to hear about that later on. I think there's a higher expectation from a tax practitioner as opposed to a small business person completing a tax return. So I think that would all be taken into account. Has reasonable care been taken based on what would be reasonably expected of the taxpayer? And looking at some of the writings in Australia and so on, when they've given guidance to taxpayers, they make the point that they expect taxpayers to read the tax pack that goes out with the tax return. So if you get a guide to the IT14, a guide to the IT12, they expect you to have read that and to have applied what is in that guide. So if the guide says we require you to declare, for example, gross dividends even though they're exempt, then you're required to declare it, and you expect it to know that because it's in the guide. All right, so reasonable care not taken, but it's all very well, you know, saying this. It still doesn't say exactly, but it's one of those terms that we have to just use interpretation, use what we would expect the ordinary meaning of the words to be, and that's what SARS would apply. Now, we get on to the more serious grounds. This next one, no reasonable grounds taken for a tax position. We've spoken about what a tax position is. And the SARS guide here makes the point that where an underpayment of tax occurs due to the taxpayer's interpretation of the application of a tax act, the understatement penalty is payable if the taxpayer does not have a reasonably arguable position. A taxpayer's interpretation of the application of the law is reasonably arguable if, having regard to the relevant authorities, for example, an income tax law, a court decision, or a general ruling, it would be concluded that what is being argued by the taxpayer is at least as likely as not correct. So if the taxpayer has considered this, certainly we were talking yesterday about obtaining opinions from experts, etc., that would certainly help you. But have you got reasonable grounds for adopting a tax position? Let's just go back to that issue around the small business corporation. You tick the box, I am a small business business corporation. Have you got reasonable grounds for saying that? Have you even looked at what the small business corporation definition says? So, if you have never even considered it, then I don't think you would really say you've got reasonable grounds for adopting that position. If you adopted it, taking in interpretation around shareholdings, etc., maybe you've got reasonable grounds. Again, it's fairly subjective, but that's just the nature of the provision. I don't need to go through the definition of tax position again. The guide goes on to say that if a shortfall arises because of a substantive disagreement concerning the application of a tax provision, this understatement penalty will be imposed if the taxpayer's position is not based on reasonable grounds. The purpose is not to levy a penalty every time SARS disagrees with a position, but to attach a penalty where a taxpayer assumes a position unreasonably. So opinions certainly would help. Getting tax opinions would help. Having minutes of meetings, having notes of discussions, etc., where a person's actually considered what is the case law lying behind this, for example, what are the tax provisions lying behind this, coming to a decision and being able to substantiate that we do have grounds for adopting that position. So that can make a very big difference, because if you don't have reasonable grounds, not my time yet, is it? No, okay. Obviously, your penalty provision could be substantially higher. Where's Mike? Is this Michael making all these noises? He's just testing me just to see if he can throw me off course here. Okay. All right. The next one, of course, gross negligence. Now we start getting into the quite scary aspect. If we're not scared already, we're certainly getting into the more scary lines here. What is regarded as gross negligence? And in fact, how do we draw a distinction between gross negligence and intentional evasion? Well, it always makes me think of the Star Wars movies, when you look at the sort of Darth Vader versus whatever his name is, the good guy. But there's an aspect where you sort of cross over to the dark side, as it were. And that's really where you draw this distinction. Because intentional evasion is where there's basically crossed over to the dark side. You're actually having this bad intention of evading tax. Gross negligence, let me tell you what the Guide to the Tax Administration says around gross negligence. A taxpayer is grossly negligent. Where a taxpayer is grossly negligent, the result may be that too little tax is paid or payable, or a tax refund is overstated. Well, that's a pretty obvious point. Gross negligence essentially means doing or not doing something in a way that in all the circumstances suggests or implies complete or a high level of disregard for the consequences. So that's your gross negligent. Disregarding the consequences. This sort of, blasé attitude, do whatever you want, who cares, how SAR's ever going to know, we can just slap anything onto the tax return type of thing. That would be your gross negligence. But you say, well, are we not bordering here on tax evasion? Well, they go on to say the test for gross negligence is objective and based on what a reasonable person would foresee as being conduct which creates a high risk of a tax shortfall occurring. Gross negligence involves recklessness, but unlike evasion, does not require an element of mens rea, meaning wrongful intent or guilty mind. So there's no wrongful intent, person just being completely reckless, negligent, but not really necessarily intending to evade tax. So again, it could be a little bit of a fine line to draw the distinction here. But they say here there's not a wrongful intent or a guilty mind or no intent to breach a tax obligation. So no intent to evade tax. That's really the bottom line here. And I guess that would be the dividing line. I don't know if the lawyers were looking at this, that might be the point of departure that they would take. As opposed to intentional tax evasion. Now, interesting to note that your percentages there, remember it used to be the old 200%, you only get to the 200% under the line of intentional tax evasion here. And then only if it's an obstructive or a repeat case. Now, intentional tax evasion, basically, the SARS guide makes the point that intentional tax evasion can exist where a taxpayer makes a false statement in a return, and even where a person does not file a return. The most important factor is that the taxpayer must have acted with intent to evade tax. Intention is a willful act that exists when a person's conduct is meant to disobey or wholly disregard a known legal obligation, and knowledge of illegality is crucial. So this is, as I say, it is really getting into the Darth Vader aspect. I mean, there's intention to evade, and and you make a willful decision. All right. Whether SARS acts on or accepts a false declaration is irrelevant. If SARS does not accept the declaration but audits the taxpayer and determines the correct tax position, the original intent to evade is not excused. Intention may at times be difficult to distinguish from an act that is grossly negligent, and that's the point that I was making just now. All right, so as we can see, the four, apart from the first line, which is clearly defined as to substantial understatement, the next four are fairly subjective. All right? And it's going to depend very much on the facts of the particular case. And the onus is on SARS to prove that those facts exist. So if the taxpayer manages their tax affairs very carefully, make sure that they properly document every decision, etc., 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 it is possible to minimize the risk around the amount of penalty that would apply. Now, in the first instance, apart from the voluntary disclosure program, the amount of the penalty is going to apply either according to column 3 or column 4. Column 3 talks about the standard case. Column 4 talks about if the taxpayer is obstructive or if it's a repeat case. And the repeat case is defined as being a second or further case of any of the behaviors listed. So if this is the second time that you have been found guilty effectively of intentional tax evasion within a period of 5 years, then that's going to be a repeat case. And the 5 years is contained within the definition of repeat case. So it talks about a second or further case of any of those behaviors within 5 years of the repeat case. All right. But obstructive, of course, again, that's open to interpretation as to what is meant by obstructive, because that is not a defined term. So the amount of the penalty, apart from the voluntary disclosure program, is going to vary from 25 to 200%. And as I say, if it's possible that you could fall into more than one category, the higher percentage is going to apply in the first instance. If the taxpayer has been levied with a penalty and they want to obtain a remission, they can, there's the objection and appeal route, of course, but there is the substantial understatement rule. Now, this is a very specific circumstance. In section 223, subparagraph 3, it talks here about SARS must remit, notice again, it uses the word must remit a penalty imposed for a substantial understatement if they are satisfied on 2 scores. But notice here, this only applies in the case of substantial understatement. It's not, so if you fall outside substantial understatement into one of those other categories, reasonable care not taken, etc., this is not going to apply to you. But if you're into the area of substantial understatement, 2 requirements. First of all, the taxpayer must have made full disclosure around the reportable arrangement by no later than the date the return was due, and they've got an opinion by a registered tax practitioner. So those 2 requirements must be met. And then there's certain requirements around that opinion, that the opinion must have been issued no later than the date on which the relevant tax return was due, must be based on full disclosure, and it must have confirmed that the taxpayer's position is more likely than not to be upheld if the matter proceeds to court. And we did talk yesterday a little bit about the status of that opinion, written opinion, etc., etc. But notice here, it must be an opinion by a registered tax practitioner. That's required in terms of the provision for this particular purpose. I mean, there are other circumstances where you don't specifically have to have a registered tax practitioner opinion, but for the purposes of this remittance, you do need that. And then the decision not to remit is subject to objection and appeal. Now, we spoke, well, first of all, let me make the point, that's the only ground for remittance that's stated within Chapter 16. There's nothing else specifically that is stated, except that going into Part B, we have the voluntary disclosure program provisions. And in terms of the voluntary disclosure program, we can see from this table, if I just go back to the table here quickly, we could see that the percentage penalty could be reduced quite substantially, and in quite a number of circumstances, reduced altogether. So under column 5, column 6, depending on whether the voluntary disclosure is applied for prior to or after notification of an audit, you could bring that penalty down quite substantially. So, for example, if you had failed to make a declaration in a tax return and that was regarded as you had not taken reasonable care, it wasn't gross negligence or it wasn't deliberate evasion, then instead of being charged with a penalty of equal to 50% on the shortfall, assuming it's the first time and it's a standard case, you could reduce that down to 0% if you apply for a voluntary disclosure before SARS commences or notifies you of an audit. Okay, now in terms of applying through the voluntary disclosure program, just to recap very quickly for any of you that might not have been there here for that earlier presentation, the VDP applies to all taxes administered by SARS, excluding customs and excise. We spoke about what type of person can apply. This was an issue that came up around partnerships, etc. But notice any person may apply in a representative, personal capacity, etc. And then there's the issue of the audit that we did go into in quite a bit of detail. SARS may permit a person who is affected by an audit to apply in certain circumstances. The requirements for a valid application: you've got to make voluntary disclosure. It would involve a default which has not previously been disclosed. It must be full and complete disclosure, involve the potential imposition of an understatement penalty, must not result in a refund by SARS, and it must be on the prescribed VDP 01 form, which can be accessed through e-filing. So the relief in applying for the voluntary disclosure program is obviously that you could bring that understatement penalty down quite substantially. There's also the relief from criminal prosecution. And there's 100% relief from administrative non-compliance penalties, excluding, notice here, it does not apply to penalties for late submission of a tax return or the late payment of tax, which is really taking virtually all of those penalties into account. So really the relief that you're going to get is under the criminal prosecution and the understatement penalty that you could reduce according to that column 5 and 6 of the table. Remember that interest would still be payable. You don't get any relief from interest. And the conclusion of the VDP process is that a VDP agreement would have to be set up between the taxpayer and SARS, which would contain certain terms. Just to finish off on Chapter 16 then, before we get on to Chapter 17, the Chapter 16, as opposed to the fixed amount administrative penalties covered under Chapter 15, Chapter 16 covers very specifically your understatement penalty. Where there's been prejudice to SARS, there's a shortfall and a certain penalty is going to apply, and it's a case of saying, what is the amount of the penalty based on the table that I showed you in section 223, and that penalty, of course, could be brought down if there's a voluntary disclosure that is applied. If we move on to, and just thinking back to that original setup I showed you of the new penalty regime with the 3 different areas, Chapter 15, the not so serious administrative, Chapter 16, slightly more serious understatement, and then of course the very serious over on the right-hand side of that table was the criminal offences. And in Chapter 17, we see a list of criminal offences that is given in section 234. But remember that the various tax acts also contain certain offences, and some of those offences are still there. They haven't all been taken out and put into the Tax Administration Act. So section 234 lists your various offences. Section 235 talks about criminal offences relating to tax evasion. Section 236 talks about criminal offences relating to the secrecy provisions, and we heard a bit spoken about on that yesterday. And then 237 talks about criminal offences relating to filing a return without authority. And perhaps it's important just to look at this before I go on to the whole list of offences under section 234, because this could apply to your tax practitioners, especially who are advising people around submission of tax returns. So what section 237 says is that a person who submits a return or other document to SARS under a forged signature or uses an electronic or digital signature of another person in an electronic communication to SARS without that person's consent or authority, or otherwise submits to SARS a communication on behalf of another person without that person's consent and authority, is guilty of an offence and upon conviction subject to a fine or imprisonment for a period not exceeding 2 years. All right. And I think we all probably sit here and think, well, I would never falsify somebody's signature or do anything like that. But just remember that when you look at the SARS e-filing terms and conditions, it's very specific there around the person giving authority for those documents to be filed under that e-filing portfolio. And the issue is that if a taxpayer is filing returns on behalf of a client, it's crucially important to make sure that you have specific authority from the client for the tax returns that you are filing. Because it specifically says here, when you're using an electronic or digital person of another person without their specific consent, you're starting to get into very dangerous territory and could end up falling into this category of a criminal offence. And I'm sure nobody sitting here would want to have to go and argue with SARS around that point. So just to make sure that you have proper authority from clients when you are acting for them. Now, in terms of Section 234, the list of criminal offences relating to non-compliance, you'll see there's a whole range of things here, going from failure to register, failure to appoint a representative taxpayer, etc. And perhaps it's important just to run through these quickly, because often when we do, there's these gasps of horror when people realize they didn't realize it was actually a criminal offense not to do a certain thing. So this issue around failing to register, failing to notify SARS of a change in your particular details, change of address, etc., etc. Failure to appoint a representative taxpayer, that's companies appointing public officers, etc. Refusing or neglecting to take an oath of secrecy, that's really the SARS official side of things. Failure to retain records or retain them in the form required, and there's some very specific record-keeping requirements contained in the Tax Administration Act and with an attached public notice around that. So one has to make sure that you retain the necessary records, including electronic records that have to be kept in a specific form. Not complying with the request issued under the information gathering powers. Not disclosing relevant material facts to SARS when required. Failure to comply with a directive or instruction issued by SARS to the person under a tax act. Refusal to give assistance during a field audit or criminal investigation as required, and impeding the collection of tax by assisting a taxpayer to dissipate assets. So those would give rise to criminal offences if done willfully and without just cause. Okay. So all in all, you can see that these penalty provisions do become fairly complex. I think what is also very important to bear in mind is when you are looking at asking for a remittance of a penalty, it's very important to understand under which provision that penalty has been applied, because remittance provisions are linked into those specific chapters. So if you are looking for a remittance of a penalty on late submission of a tax return, that is different to a remittance for an understatement penalty, for example. And you would have to look at the specific grounds for remittance contained in those various chapters. As I say, having been through this presentation, I also feel that I have to make a bit of a disclaimer, because Katinka from SARS has already indicated that there's going to be quite substantial amendments to these provisions coming through later this year. So what we're covering now is the Act as it stands right now, but we have been told, and it was mentioned in the budget speech and we've had further clarity here, that there are quite a number of changes that are coming. So as much as we could understand the legislation as it is now, just be aware that there are more changes coming through. So you would have to just keep tabs on those changes so that you are up to speed with the treatment going forward. Okay, shall we take some questions? There's a bit of time. I've left 15 minutes to take questions. Yes, Eric. I might need you to just get a mic.
I have two.
Yes, it was better before. Just try it. It was coming through the first time you spoke into it. I think just, yeah.
Hello?
Yeah,
okay.
It's fine.
Two questions, Jackie, please. One is, what happens in the fixed where you do not receive the notice for a fixed penalty? And we had a case where the taxpayer received an SMS from SARS saying that there is an amount owing to them, and when we looked it up eventually and got hold of SARS, it was an admin penalty or a fixed rate penalty for non-submission of a tax return that accumulated for a couple of months. And we never on e-filing received any notification that the penalty notice had been issued. And the second question is, a taxpayer gets a refund that is not due. If the taxpayer does not notify SARS that they've made an error, what, if any, penalty could be imposed if SARS subsequently finds it?
Okay, interesting. On the first one, obviously, the issue is around, it comes back to the fact that the penalty is raised on a penalty assessment, and so all the rules around assessment will apply there. So has the assessment been delivered to the taxpayer, etc.? And the question really would be whether SARS has your correct address, because it should have come through, obviously, through the e-filing profile. So it's a little odd that it would not have come through there, and I'm not quite sure exactly what the circumstances are. I would imagine the SMS that was received by the client was for the subsequent monthly penalty, which at one stage SARS was sending SMSs on those. But the actual delivery of the assessment hinges back to the rules around delivery, that it should have been delivered to the taxpayer's address. Under the old rules, it would have been posted, but currently it would come through on the profile of the taxpayer. So I'm not quite sure. I mean, other people experience this as well, that they just simply don't get the assessment. And I don't know if anyone's ever come across a solution to that as to why wouldn't they get the assessment? Because, I mean, surely it should come through. I'm not... Yeah. It bounces back.
On the e-filing
profile, yeah. Yeah, that you should, and I know I've had one of the employers come to me a little while ago, and they had all these notifications as the agent, the 88 form, and those were all sitting there as well, and they didn't know that they were there. So there would be the expectation, I guess, to go in and have a look at any documents that are sitting there. Failing that, as far as SARS is concerned, they have delivered. I guess you could think about it in a manual situation where they would have posted it, it's sitting in your post box at the post office. If you never go and look at the post box, it's not SARS' fault in that sense. You need to go and see what is there. So I think from SARS' point of view, they would say that delivery has taken place there and that the taxpayer is deemed to know that the assessment is there. But of course, it's fact specific. There might be certain circumstances as to why that would not have happened. In terms of the refund from SARS, the recovery provisions in the Tax Administration Act do say that SARS can take action to recover a refund just as if it was an amount of tax owing by the taxpayer. But is there an obligation on the taxpayer to notify SARS? There's a very strong argument to say that there isn't an obligation. Maybe there's a duty of just being a good citizen to notify SARS, but we've also heard of cases in the past where people have tried very hard to tell SARS that there's a refund that has been made in error, and it's actually ended up just costing them a huge amount of time, and at the end of the day they end up just by hitting their head against a brick wall, because it becomes, the whole situation actually gets quite unpleasant. So there's not a specific duty in the legislation that you have to notify SARS of that refund. However, SARS can take action to recover the refund. So if somebody has gone and spent that refund, it doesn't alleviate the opportunity for SARS to still try and still recover that money from the taxpayer. Beric, I don't know if you wanted to mention in terms of the rights of the taxpayer, is there an obligation to notify? What would your view be on that one? That in terms of public duty there would be an obligation, yeah, but there's not a specific legal duty to notify. Or is there? We have missed one. I haven't, okay. I don't. Okay. Shall we, is there another question?
Sorry.
Yeah.
Hello, sorry.
Jackie?
This.
Oh, yeah, sorry. Yes.
Sorry, coming back to the underestimation penalty and the VDP program, is it per tax type? If you're under audit for pay-as-you-earn, for that, because you're not under audit, can you claim the lower penalty? Is
So
it per tax type?
Okay, so you're talking about an understatement penalty on?
Just say pay-as-you-earn. You've been audit investigated for pay-as-you-earn.
All right.
But now you want to go for VDP under VAT. Can you claim the lower penalty because you're not under investigation for VAT, but for PAYE?
Well, the issue around the VDP talks about where a person is under audit and basically says if the person's already under audit, SARS may allow them to still apply for the VDP if their audit would not have disclosed that particular area. So in your case where you're talking about two completely different departments perhaps, or two different processes, it's quite possible that an audit of one would not have discovered something in the other area. So you could apply the provision to say we should still be eligible to apply for the voluntary disclosure program. And SARS would be able to approve that. So assuming that you've been allowed to proceed with the voluntary disclosure program on that basis, then you would be looking at the lower percentage. But you would know that through the process in terms of whether the voluntary disclosure application has been allowed. Yes.
In terms of smaller errors which are not substantial, assuming none of the other more serious cases don't apply, by implication, does that mean that there is no understatement penalty due?
Well, I would venture to say, if I just get this table, it's been taken off the slide here. But in many cases, especially with smaller business, substantial understatement is not going to apply because that's really talking about quite substantial amounts as the term indicates. But let's say that there's, for some other reason, there has been prejudice to the fiscus because there's been an understatement of some form of tax liability. It's pretty much going to fall into one of those areas because it's going to have arisen in one of those four circumstances. It's just a case of which one applies. From the more sort of innocent, reasonable care not taken, simple mistake, all the way through to intentional tax evasion. But those are areas, I get a sense from SARS that those are areas that are subject to some amendments coming through during the course of this year. So we might see a little bit more clarity in terms of that. But I would venture to say it's going to fall into one of those four. Yeah.
Okay, my second question, the grounds for remittance. On your slide, it said it's only applicable to a reportable arrangement. Is that correct? As well as having the opinion from the tax practitioner. So it's the two conditions you need to meet.
That ground, the ground for remittance that you're referring to is on the understatement, and then it's under section 223, subparagraph 3. So it's talking specifically about a remittance of a penalty imposed for substantial understatement. So you're really into fairly large amounts here. And then we're saying full disclosure under the reportable arrangement and that you got the opinion from the tax practitioner. So there's an and between those two.
Yeah, but it needs to be a reportable arrangement in the first place.
Yeah, no, sure. And it's got to be a substantial understatement. So we're not talking here about anything that falls less than R1 million, basically, because it's the greater of the R1 million or 5% of the tax property chargeable. Katinka, yes, are you going to add something there?
Yeah, just quickly on this last issue. Substantial understatement penalty is essentially only remittable in the case of a reportable arrangement because of the the complicated nature thereof. So it's only if you can demonstrate that is the scenario that triggered a substantial understatement penalty that the remittance would apply. In all other instances, you'll have to pursue objection and appeal. And just to remove another certainty that came across, and not necessarily here, is the fact that any other understatement penalty, you would have the right to object and appeal, but that would be under section 104 that says if you are aggrieved by the assessment, which gives effect to the understatement penalty, you have the right of objection and appeal.
Yeah, I mean, that's a very important point that you make, that when we talk about the dispute resolution process, in terms of section 104, any taxpayer who's aggrieved by an assessment made by SARS can object. And a penalty, remember, is raised on an assessment. So although you don't have the specific remittance available there, you've got the normal objection and appeal route that is available.
Leslie on that side. Just a question on understatement penalties as well. I don't think it really applies to substantial understatement because the calculation would always get you out of it. But in terms of sort of some of the other behaviours, what happens when a company is actually in an assessed loss and it's misstated its assessed loss? Clearly that's a shortfall for purposes of that provision. But there's we're battling to see where, if your assessed loss is meant to be 1 billion rand and you've restated to 1.2 billion rand in error, or for whatever reason, how SARS can be prejudiced by that misstatement.
So we're saying that your assessed loss effectively is overstated?
Your assessed loss is overstated, but because you're not in a tax-paying position, and you foresee you're not going to be in a tax-paying position for 4 or 5 or 6 years, where exactly? I mean, the whole understatement penalties are premised on there being a prejudice to SARS. So for us, it seems a bit strange that there's a prejudice required, but one of the shortfall areas actually is where there's been a misstatement or an overstatement of assessed loss.
Yeah.
So we're kind of battling to reconcile that.
Yeah. I suppose, look, I mean, you are making the point that assessed loss is not going to be applied against taxable income for, foreseeable future, but the view would be that assessed loss effectively is a benefit available against some sort of future taxable income. So if your assessed loss is overstated, you are overstating a benefit that is going to be realized in some later year. And the idea is, I suppose, that assessed loss would be utilized. In reality, you might say, well, in a particular circumstance, we're never going to realize this assessed loss. And I suppose you are saying that one could argue that there isn't a prejudice to SARS. Although having said that, when we talk here about the prejudice and the shortfall, as you say, the assessed loss is specifically listed as one of the aspects of shortfall there. But is there prejudice? Well, in most cases where one would expect that you would use that assessed loss at some stage, the prejudice is understandable. But I suppose in an extreme situation, you might be able to argue that there isn't a prejudice.
Sorry, Jackie, just to come back to Section 223, subsection 3 on the remittance.
Yes.
I just wanted to clarify Katinka's comment there. My reading of subsection A refers to full disclosure of the arrangement that's defined in Section 34.
Yeah.
So Section 34 arrangement is any transaction, operation, scheme, agreement or understanding. Is the view that has to be a reportable arrangement or an arrangement as defined in Section 34?
It's an interesting point that, because I mean you would expect it to be a reportable arrangement, but you're correct, arrangement is simply defined quite blandly. But would you like to add to that, Katinka? Yeah.
The mic is...
We need a mic, sorry. Yes, Paul, just very quickly, while we're waiting for Katinka.
The last comment is correct. That's the view expressed by SARS at the parliamentary committee. So let's say there's parliament that is the view. It's not a reportable arrangement.
It's that arrangement. Let's have a look and see.
The reportable arrangement term is defined in Section 1. It will therefore apply to Chapter 16. The term arrangement only is a chapter-only definition in Chapter 4 and only applies there. But reportable arrangement is a Section 1 global definition, as Costa likes to call it, so it applies.
Okay.
But that is one of the potential problems we are looking at.
Yeah,
yes.
I'm sure you're going to tidy that up, especially.
Yep.
Okay. All right.
At the back.
Yes, at the back. Okay.
Yes, I just want to find out if a VAT vendor does export services or have zero-rated services, and he does not declare that on his VAT 201. Is that a substantial understatement or any type of understatement?
Yeah, well, I mean, if you basically you're going back to, and that's why it's useful to have these definitions in the Act, because you're essentially going back to say, is there prejudice? First of all, is there prejudice to SARS? It would seem not in that circumstance. Is there a shortfall, and it doesn't seem to be listed there? So there isn't a prejudice. If there isn't a prejudice, because as was pointed out, this whole section is premised on the basis that there's a prejudice to SARS. But there might be something else around failure to submit a tax return, etc., which could come into an administrative penalty. But in terms of understatement, I would venture not. Yes.
Just a comment on what's currently happening with the understatement penalties. When the taxpayer receives the letter of findings, there's a little paragraph at the end that requests of the taxpayer to give reasons why the understatement penalty shouldn't be levied. Now, I think that's not correct, as the onus rests on SARS to prove that. So my suggestion or thought is that your letter of finding should include these grounds, and that will enable the taxpayer to comment on them as in line with the whole principle of the letter of findings. Then that should also include in that diagram specifically what percentage they want to impose and the grounds so that the taxpayer can comment thereon.
Yeah, I think it's a very valid point and suggestion that you make in there. I agree.
I think that's it.
All right, I think time is up. Let me hand back to our chairman. Thank you. Oh, sorry, did you want to comment on that?
I think it is correct.
No, it's not a reportable arrangement. It is an arrangement as referred in Section 34. So apologies, it's Friday morning.
So arrangement as
long
defined,
week.
Transaction operation, etc.
Yes.
Okay.
Not just reportable arrangements.
Okay, interesting. Just shows you these things are nothing if not complicated. Okay, thank you. Thanks.
Thank you very much, Jackie. That was very insightful. I think if we can break for tea and resume at 11, that would be great. Thanks.